Hello, Accounting 101 students. This is Miss Mandra, and in this video, we're going to go over some of the content in Chapter 3 using the end of chapter practice exercise number 6. In Chapter 3, the main areas of focus include the accounting cycle, recording business transactions in journal entries, posting journal entries to the general ledger, and preparing the trial balance. And in Chapter 3, we go through the accounting cycle. The first part of the accounting cycle is to analyze business transactions. And we analyze business transactions utilizing the basic accounting equation, which is assets equals your liabilities plus equity. The next step of our accounting cycle is to journalize those transactions. And in each journal entry, we want to include the date of the transaction, the accounts that are being impacted, and whether the impact is a debit or a credit to each account. After we record the journal entries, we would post the journal entries using the T account format to the general ledger, and we would take the ending amounts from each of the T accounts, and we will include those amounts in the trial balance. And the trial balance is a listing of all of the accounts that a company uses at a particular date, and the account balances whether they are in total a debit or a credit at the end of the reporting period. Now we are going to go into our Canvas website, and we will be looking at the modules area. For our Chapter 3 content, this is continued in our Week 4 module. And in our Week 4 module, I have included the end of chapter practice along with a Wiley solution walkthrough video on journalizing transactions, as well as some additional handouts with the solutions for you to practice journalizing transactions. So you can click on the video if you want to have another review over practicing this content. And right now we will go ahead and go through the end of chapter practice questions. And specifically, we will do question 6 because it's a very comprehensive question. I will start off by giving you an overview of what you will be doing in this question and all the different parts that we want to focus on. So in question number 6, we are given some data. This is Ayala Architects, incorporated as licensed architects on April 1st, 2017. During the first month of operations, the following events and transactions occurred. So we're given a lot of different events that have occurred in the month of April. And in this problem, we need to journalize the transactions using the proper journal entry format. In this problem, we need to include the date of the transaction, the account title. So what are the accounts that are being impacted? For the purpose of this exercise, we do not need to include an explanation. We would also include the amount that is being debited and the amount that is being credited. So we will include in those amounts. You'll notice that if an amount does not impact a credit, you would leave that area blank. And if it does not impact a debit, you would leave that area blank. Next, we will be posting those journal entries to the ledger T accounts. For each of the accounts that are being impacted in those journal entries, we would include the debit amount on the left side of the T account and the credit amount on the right side of the T account. And our main purpose here is to have a running balance of all of the transactions that impact each individual account in order to come up with our ending balance at the end of the reporting period. And we will use that ending balance in order to prepare the trial balance, which is the listing of all of the accounts that a company uses in a particular order. And it will have the ending balance, whether it is a debit or a credit. And at the end, we want to make sure that the total debits equal the total credits. So I'll be taking some annotation notes as we go along. The first transaction occurred on April 1st, but before we even start discussing the transactions, it's a good idea for us to review our debit and credit rules. So in our study guide, one of the tips that I have provided is an acronym, and the acronym is called DEALER. So DEA equals LER. And what this means is we think about our basic accounting equation and we think about ways that we can remember these rules. So in our basic accounting equation, our assets equal our liabilities plus equity. So our assets are on one side of the accounting equation and our liabilities and our equity are on the other side of the accounting equation. And we notice that with our debit and credit rules, assets increase with debits. And on the opposite side, we have our liabilities and equity. And we notice that our liabilities and equity increase with credits because those are on the opposite side of the accounting equation. We also think about the impact of the items that are included within equity. So for example, within equity, we also have retained earnings and revenues. Retained earnings and revenues increase equity, so they also increase with credits. We also consider dividends and expenses. So expenses reduce the net income, therefore they reduce retained earnings and they reduce equity. So actually expenses are going to do the opposite as what the other items in equity would do. Expenses are actually going to increase with a debit. And you can think of dividends similarly, where dividends reduce the retained earnings of a company, and therefore they reduce equity, and we would include those dividends as increasing with debits. So we want to make sure that the two sides of the accounting equation balance out. So in our first transaction, we want to note the key accounts that are being impacted. On April 1st, stockholders. When I see the word stockholders, I know that my equity section will be impacted on the balance sheet. What did the stockholders do? Well, they invested an amount of cash. So I know cash is increasing because I've received an investment in exchange for common stock of the corporation. So when you know what accounts are being impacted then you can apply the debit and credit rules. So in this first transaction, we notice that there is an increase in cash. And every time we have cash go up, that means an asset has increased, and that will be a debit. And that is corresponded with an increase in common stock, which is an equity account, and that will be a credit. And I'll be abbreviating increase with INC, so that way we have enough room to include all of our transactions. So when it comes to the journal entry, what you will be doing is you will include the date of the transaction. So we have April 1st, and you'll notice that the account that we're going to debit is listed first on the very top. So we're always going to include the account to debit will be listed first on the top. And we will include the amount to debit in the debit column. The account that we will credit will be listed on the next line. And you will also notice that there is a small indentation for the account that we're going to credit to make it easier to view. And the dollar amount that we're going to credit will go into the credit column. And the other columns that we don't use are just going to stay blank. So that's the first transaction. In the next transaction, also on April 1st, the company hired a secretary receptionist at a salary of $446 per week, which is payable monthly. Because they have only hired that secretary, the secretary has not yet worked, there is no impact to assets, liabilities, or equity. That secretary can decide that they don't want to work for Ayala Architects and choose employment somewhere else. Or when they do work, that's when we will record the salaries and wages expense. But at this point, because we've only hired the secretary, there's no entry. And in your problem, you can just type in no entry. And for the debit and credit columns, you're going to input 0 because there's no dollar impact at this point. In the next transaction, on April 2nd, the company paid office rent for the month. And because I see the word paid, that means that money is coming out of my bank account. There is going to be a decrease in cash. And the reason for that decrease in cash is for rent expense. So I notice that because I have the word paid, I have a decrease in cash. That will be a credit. And I have an offsetting recording to rent expense as a debit. In the next problem, so the next part of this problem, the company has purchased architectural supplies. So we have a purchase, and what we purchased was supplies. So anytime we have a purchase, we have to pay for it. If we pay for it now, it will say that we have paid, or the word cash. Or if we will pay for it later, it will be on account. So we have an asset, we have supplies that are now available for us to use. So I'm going to go ahead and record an increase to my supplies, which will be a debit, and a corresponding increase in my accounts payable liability, which will be a credit. All right, so our next transaction here, on April 10th, the company completed blueprints on a carport and billed the client for services. So right here, we know that we have completed services. So that means we can record the revenues. So we want to go ahead and record service revenue. Service revenue increases our net income, which increases our retained earnings, which increases our equity, and therefore will be recorded as a credit. So we have an increase in service revenue. And because we've performed a service, we should get paid. We didn't receive money now, we will receive money later from our customer. So we have an increase in our accounts receivable asset, and our increase in our asset will be reported as a debit. In our next example, on April 11th, we received cash, but we received that cash in advance from M. Jason to design a new home. So it seems that we are receiving a cash advance, a deposit from our customer, and the reason for the deposit is to design a new home. So I know that I'm going to have an increase in cash, which is an asset account. So that will have a corresponding debit. I also need to note that there's a reason why I received the cash, and I need to perform the design services for the new home. And because I have not designed it yet, I have not provided the service, I now have a liability. The liability is to design the home, and if for some reason I'm unable to do that, then I need to provide a refund. So the account I'm going to be using is called Unearned Service Revenue, which means that I have not yet earned that revenue because I have not yet provided the service. So it is a liability account with a credit balance. In our next transaction on April 20th, the company received cash. And the reason why we received cash is for services completed and delivered to S. Melvin. In this example, our company has already provided the service. When we provide the service, we get to record service revenue, and our revenue will be a credit. We also notice that we have an increase in cash, which is an asset noted with a debit. On April 30th, the company paid the secretary receptionist for the month, and now we know that that secretary receptionist has worked for the company. So anytime I see the word paid, I know that my cash is decreasing. So that decrease in cash is going to be a credit. And the reason why my cash is going down, it's decreasing, is because I have salaries and wages expense for the employees that have worked, and my expenses will be noted with a debit. In this last transaction in April, the company paid money to Birmingham Company for accounts payable due. One of the things that's really important when you're doing your journal entries is to go in chronological order. So go in sequential order based on date. And you'll notice that all the way back on April 3rd, the company had purchased supplies from Birmingham Company. So in this transaction, we're not buying the supplies again. All we're doing is we're paying off the amount that is due. So for our journal entry, anytime I see the word paid, I know there is a reduction in cash. So I'm going to decrease cash with a credit. And the reason for the decrease in cash is that I am reducing my accounts payable liability when I pay it off. So when I'm reducing my liability, that will be noted as a debit. So these are the transactions. And next, I'm going to display the journal entries associated with these transactions. So I'll be clearing these annotation notes. That way you can see all of the journal entries that are in line with what we discussed for these transactions. And I will be zooming out just a little bit in order to capture a little bit more of the screen here. All right. So for each transaction, we have the date, we have the accounts that are being impacted, and we have the amounts that are either going to be recorded as a debit or a credit. So one by one, you should include the account titles and the corresponding amounts in either the debit or the credit column. And this is also a good time if you want to pause the video. I know that the numbers that every student has in their end of chapter practice is different from the numbers that I have presented here on the sample problem. So this is a good idea to pause the video so that way you can go ahead and go through this process of actually recording all of the journal entries with the numbers that you have in your problem. After you have recorded all of the journal entries, the next step is to post to the Ledger T accounts. For the Ledger T accounts, we have each of our accounts having its own individual separate T accounts. And based on the transactions, you're going to include the dollar amount either on the left side, which is the debit side, or the right side, which is the credit side. So for example, on April 1st, we have a transaction that impacts cash and common stock. So in my T accounts, I'm going to note the first thing is on April 1st, I impacted cash, and the debit amount is $21,420. So when I scroll down to my Ledger T accounts, for cash, I'm going to include the date of April 1st, and I will include that amount of $21,420. The next line on April 1st is for common stock. So the next line here is for common stock, and I will include the amount of $21,420 in the credit column for the common stock account. So on the credit column, I'm going to be including in the dollar amount. And you will continue to do this for every transaction. If there's no entry, there will be no impact to any T account. And you will continue the process for all of these journal entries. Once you are done posting the amounts to the respective accounts, then you will come up with the ending balance. So the way how you would come up with the ending balance depends on the classification. For asset accounts, your ending balance will be determined by adding all of your debits, and you're going to subtract your credits to arrive at the ending balance. So you can go chronologically in order by date. So you can add the cash debit balance on April 1st, and then you can subtract the cash debit credit balance on April 2nd. Then you would add the cash debit balance on April 11th, and so forth. And the point of this is to know what would be the balance at any given point in time. And at the end of the accounting period, you want to know the ending balances to prepare the trial balance. So we want to arrive at the ending balance. And the normal ending balance for asset accounts is debit. So we would expect there to be positive cash, so that would indicate a debit balance. We would expect there to be positive accounts receivable. You either have supplies or it's zero, but you wouldn't expect to see a credit balance in your supplies ending amount, and so forth. Our next group is our liabilities. For liabilities, and your equity accounts, you will add your credits and subtract debits to arrive at the ending balance. And your normal ending balance for liability and equity accounts is credit. In addition, your revenues and your retained earnings, any of those accounts would also have a normal ending balance as a credit. Next, we move on to our expenses. For expenses, as well as for dividends, you basically just have debits, so you just need to add your debits together. And our normal ending balance for our expense and dividend accounts is debit. So I'll scroll down a little bit so you can see that for our expense accounts, you only see transactions that are impacting debits. That will be the same case if we had a dividend account. So far in the semester, we will be showing that our revenue accounts are going to be recorded when we have earned our revenue, which indicates a credit balance. So these are the basic rules in terms of how you arrive at the ending balance. So we're going to take all of these ending balances from each individual account, and we will be preparing the trial balance. The trial balance is prepared as of a particular date. So you want to notice that the trial balance is prepared at a specific date. And there is an order for this trial balance. And the order for the trial balance first starts off by having the balance sheet accounts in the order of the balance sheet. Then we have the retained earnings accounts, which is basically going to be your dividend account. And then we will have your income statement accounts. So that will be the order for the trial balance. And we start off with the same order that we would have a regular trial balance, or a regular balance sheet actually. So we'd start off with the order of the balance sheet with the current assets of cash, accounts receivable, supplies. If we had any long-term assets, those would be listed next. So if you had any long-term investments, if you had any property, plant, and equipment, or if you had intangible assets, those would be included as part of the long-term assets. Then a company would include their current liabilities. So we would include our current liabilities. And if they had any long-term liabilities, they would list those afterwards. After the liability section, we would have equity. So we'd have our common stock and retained earnings. And after our equity, we would include in our dividends. Last, we would include accounts that are on the income statement. So we will have our revenues. And then we would include in our expenses in the same order that we would present them on the income statement. So this is the basic order for the trial balance. I recommend looking at the textbook for illustrations when you have more accounts than what we have in this problem. And what we are doing here is that we want to have the ending balance from each individual T account in either the debit column or the credit column. So you should have the ending balance on either column, and you would add up the total debits, you would add up the total credits, and you should see that the total amounts of your debits and your credits have to equal out. And this is something that you want to check for. And this basically tells you that your accounting equation is in balance, but there are some limitations. There are some limitations to the trial balance. So some of these limitations that you want to be aware of. And I highly recommend reading through these limitations in the textbook in a lot more detail. Some of the limitations include the trial balance won't indicate if you posted something to the incorrect account. So perhaps you mixed up salaries and wages expense with your rent expense. Another limitation is, what if you completely forgot to record a journal entry? You completely omitted that journal entry. Well, your debits and your credits will balance out, and you wouldn't really know that you've omitted that journal entry unless if you had a really good understanding of what the balance should be. Another issue is that if you have transposed the digits, so if you flip the digits, instead of typing in 73, you typed in 37 in your journal entry for both the debit and the credit, you wouldn't really find that error because the same error was happening on the debit and on the credit. So there are some limitations to the trial balance. I recommend reading those in your textbook and also completing those in the study guide. So that is the end of our recording, and thank you for taking the time to watch this.